You need three things to buy a house. You need cash, you need credit, and you need income. Two of the three things I and the colleagues I work with in the lending world can help you with. One of them I cannot help you with. We're going to be talking about that today and a whole lot more on today's edition of the Brian Hirsch Show. Well, good morning or Monday afternoon to you, wherever you may be. Thank you so much for joining us today on our edition of the Brian Hirsch Show. Whether you're driving in your car or sitting in front of your computer watching or listening to today's broadcast, we sure appreciate you and hope that we can help you today in understanding an integral part of the housing market. So when people call me and they ask the indelible question, we're thinking about buying a house. What do we need to do? I answer them by saying, well, you're going to need three things to buy your house. You're going to need cash, you're going to need credit, and you're going to need income. So on the on those three things, two of them we can help you with. We can help you repair credit. Most of the lenders that I work with have some kind of way to repair your credit and get you to the scores that you need to get to. And incidentally, what most of them are looking for is a mid FICO score of 660. And you need income. That's the one thing I can help you with. If you don't have a job, there's nothing I can do about that. And then there's the third thing, cash, right? So with cash, what specifically we're referring to is your down payment, which if it's a standard FHA purchase is 3.5%. And then on top of that, you're looking at about 3% for your closing costs. So if it's a $400,000 house, you're going to need somewhere in the neighborhood of, give or take, $20,000 to close on that deal. That would be your down payment plus your closing costs. So a lot of first-time buyers don't have that much cash on hand. It's different. Like if you're going to sell a house and buy another house, you can leverage the equity in the house you're selling to deploy into the new house. But if you're a first-time buyer, you have to gather all that money up in cash. And so the way most buyers look to kind of chop down that $20,000 bill is first to get a credit from the seller. The market today is allowing for 1% to 2% credit from the seller to the buyer. That would be what we call a concession. Let's say if we were able to get 2% on a $400,000 purchase, that would be $8,000. So we chopped it down the down payment or the cash to close figure from $20,000 to $12,000. The next place to go is to get either a lender credit in exchange for a marginally higher rate or gift funds from a family member or friend. And then what we're going to be talking about today is a down payment assistance program. And there are a couple of them out there. And so today we are delighted to have with us one of the finest lenders and brightest minds when it comes to lending in the real estate world. His name is Craig Lawrence. He's with the Loan Depot, and he is coming today to share with us his treasure trove of knowledge when it comes to all things down payment assistance. Everybody, please welcome to the Brian Hirsch Show, Craig Lawrence. How are you, my friend?
Hey, I'm much better after that introduction. Very cool. Good to have.
Cool.
Thanks for asking me to be on. Jump on.
Yeah, absolutely. Now, I think your website or your email says you're in Indian Wells. You live down in the low desert?
No, we're Apple Valley. We just don't have a physical location at this point in the high desert.
Oh, I gotcha.
Okay. We purposely have done that so that we could save our borrowers costs and different things like that.
The brick and mortar kind of model is becoming antiquated because it's expensive.
It's very expensive.
Right? Yeah. So, and you've been here locally. I mean, gosh, I remember, I think you came by an open house I was working. It had to have been 8 years ago. I mean, so you've been up here for a while, right?
Yes. I started in the late 90s. So this is I think this is my 24th year. as an
Oh,
LO in the high desert. Yeah, been here,
so
been
you've seen
around.
the good, the bad, and the ugly.
Yeah, been through it. Yeah, been through it for sure.
Are
It's
you
been a
original to
roller
the
coaster.
desert? Did you grow up here?
I was born in Banning, California, but
Uh-huh.
my high school, I would say my junior high school years were here in the high desert, and I went in the military right after high school, 6 years in the military in the Air Force, and then I came back, and then I worked in a truck. I went to college, and then eventually worked at a trucking company for in the most of the '90s in a trucking company, and lived in Fresno for about 4 years during that time frame. And then I moved back down here, and I was commuting to Los Angeles, and my sister worked with the eventual owners of PRMG, and she's like, "You got to get in the lending business." And I said, "No, I don't want to do that. I got a good career. I don't want to deal with this." And she
Mm.
introduced me to a couple of people, and yeah, I couldn't say no. It was an odd relationship at the beginning as far as this business. This is a not for the faint of heart,
Isn't that the
and
truth?
it definitely was a struggle. I was so used to just being able to do things the way I wanted to do things, and that's not how it works.
You
You
know,
have
you
to.
knew my mom,
Yeah.
Paula. Yeah, she was a perennial, you know, top 5
Legacy.
agent. Yeah, legacy.
Right.
Yeah.
Yeah. Yeah.
I was talking to her a little bit about just the state of the market. It's a little bit unprecedented where we are right now. But she talked about longevity in the business and how that in and of itself is, something that's an item of value when it comes to selecting who you use as an agent or lender. And obviously, you've got longevity in the business. And as you said, not for the faint of heart. What years did you serve in the Air Force?
I was 87 to 93.
89 to 93.
Oh, nice. Nice. Nice.
U.S. Air Force.
Where were you at?
I was stationed at Cannon Air Force Base in Clovis, New Mexico.
Nice. I was at Carswell, which is no longer a base. And then
Mm.
I was at Hickam for 4 years.
Wow.
Hickam in Hawaii. Yeah. So I was a
Well,
canine handler. What'd you do?
I was a fire protection specialist.
Oh, very cool.
Yeah.
How did you not go back into
I
the
didn't
fire
like
department?
it. I
Really?
didn't know. I didn't like it at all. I'm grateful and am proud to have served, and I'm grateful for those years. I look back on them, and it's I'm very grateful for those years. But I just did not enjoy that line of work at all. And plus, I just felt the calling to pursue vocational ministry. So when I got out of the Air Force, I went straight into the ministry. I have a friend who did, I think it was 6 tours. He was Army,
Oof.
retired Sergeant Major, which is, I believe, E9
Right.
in the Army. And he did, I think, 6 tours over in either Afghanistan or Iraq, and Purple Heart, and the whole bit. And I said, "Yeah, man. Well, I got you beat. I did 4 years in Clovis, New Mexico."
Yeah.
We joke
Yeah.
about that, but thank you for your service, Craig.
No, thank you for yours. Yeah, I had an interesting time. I was a canine handler and bomb dog handler. Enjoyed the
Wow.
time. It was an interesting thing, and really fit my personality style. And it really shaped my personality style going into the mortgage industry in the late '90s. Ultimately, you mentioned longevity, and I think what it comes down to is having the experience to fix and solve problems.
Mm,
I really think that
yeah.
that is kind of what makes the longevity aspect really good, because you have two things in real estate in our business is longevity or a lot of transactions. If you can get the opportunity to do a lot of transactions, you're going to see a lot of problems. And
Yeah.
longevity gives you that, right? Longevity gives you that, a lot of transactions, a lot of problems. And the opportunity that's available now is the solutions that we can talk about, which would be the down payment assistance and solving all the other issues that come up. Because nowadays you have so many issues with solar, you have issues with comparable sales, you have income issues, interest rate issues. There's a bevy of problems that arise during the transaction, and the last thing that you can do in a transaction is panic.
Right.
So you can't panic. You can't let anybody know that you're angry. Don't let them see you sweat. I think that was
Right.
like a commercial back in the day.
Mhm.
You can't panic, because once they see that you're panicking, they lose faith that you're going to be able to solve their problem for them.
Right.
And
Right.
I think that's what really the longevity piece does, is allows you to not panic, keep a very smooth and
Mm.
even keeled personality style. And generally speaking, it you can only do that through longevity or tons of transactions.
Right.
Then that's really what it boils down to.
Yeah, I tell clients sometimes, well, things come up and they are in a very emotionally vulnerable place when you're going through a real estate transaction. It's the highest. I mean, it's just a very stressful thing to buy or sell a house. And so for that reason, and every personality is a little different too. And when they're dealing with some unknowns and they're not sure what's going to happen and they're trying to make plans and it's hundreds of thousands of dollars and their most basic human need for housing and blah blah blah, people can get into panic mode and worry mode pretty quick. And so I just tell them, look, do not panic until I panic. When I panic, you'll know we're in trouble. uh,
Right.
so long as I'm not panicking, everything's going to be okay, and we're going to work through this. And like you said, somebody that's the value added proposition vis-a-vis a real estate broker like myself or a loan officer is your ability to solve problems.
Right.
And that is part of what's going on. And one of the solutions that we're talking about today is solving the problem of the cash to close figure. I talk to people, Craig, sometimes that are from a previous generation that look at me with a little bit of a raised eyebrow when I am coaching them through listing their home for sale and predicting the probable client or customer that is going to buy their home. And I'll kind of talk to them a little bit about, the three things you need. One of them's cash and cash to close and the amount of money that they're going to need to buy the house and so on and so forth. And that they're likely going to come to us for a credit. I mean,
Right.
that's just part of it. I mean, it's the reality. And this speech was more commonplace pre-COVID because of that 2-year period where everybody was selling, cashing out a couple $100,000 and redeploying. And that's why we saw such a dramatic increase in the market. But now it's kind of more stabilized and we're back to, sellers, giving some credit. And I would tell them, look, it's probably going to be an FHA buyer. They're going to need 20 grand in cash to close. The likelihood of them having 20 grand is not high. They're going to come to us. They're going to ask us for 1% to 2%. And that's what raises the eyebrow. And I'll say, and you need to get down on your knees and thank God Almighty for this FHA buyer that's asking you for a 2% credit, because without them, the absorption rate shrinks dramatically.
Right.
And they're the ones setting the standard on the value of your home. So without those people, the asset that you have that the market says is worth 500,000, well, guess what? The market dictated and set that price from all these FHA buyers that bought
From the
these homes,
demand.
right?
Right.
I mean,
Right. Right.
without them,
Right.
you eliminate. And so you tell me, what is the ratio right now of the customers you're working with that are, the 20% conventional buyer versus?
Oh, it's definitely much higher on the FHA side, or I don't even like to call them FHA to a degree. There's challenged. I call
Okay.
them challenged.
Yeah.
They're either challenged in assets, they're challenged in credit,
Income. Yeah.
or challenged in income. So you
Yeah.
have to figure out the best solution, a best strategy to help them. And I'm just a big believer in what are ways that we can keep money in your pocket, because at the end of the day, when you move into a new home, you're going to find something that you're going to want to replace: carpet, paint, furniture. TV, refrigerator. You're gonna need something on the back end to be
Right.
able to absorb some of those costs.
Right.
Besides the loan costs, I mean, besides the mortgage costs and besides the moving costs, you're gonna need something. You're gonna want to have a little bit extra. And so, how can we as professionals be cognizant of that fact? Do we ask a seller to give a credit? Do we come up with down payment assistance? Do we do lender credits or what have you? What are some of the ways that we can help people go into that property with essentially a backstop to help them? What can we do to help solve the problem of moving into that home and having money on hand, cash on hand to absorb the new home? I mean, there's going to be problems that you're going to have to face, or some things that you're going to want to replace on that new home, like I had mentioned. But that's how I look. That's the prism I use every time I talk to a borrower, whether it's a down payment assistance or challenged or conventional, or it doesn't matter what the solution is. My strategy mentally is always, how can I save this person money? How can we keep money in their pocket? And I think, asking for seller concessions, that's always a great way to do it. Ultimately, you're just financing the concession.
Right.
You're not really,
because it's coming out of the equity of the house.
Right. It's not necessarily coming out of the.
I try to explain this to the sellers. I'm like, look, the market says your house is worth 500,000. Without this buyer, it's probably worth 400,000.
Right. Or
right.
less.
So, I mean, you got to have a buy. Like, this is maybe another podcast I'll do. How much equity do you have in your house? And sometimes I ask sellers that. I'll say, well, how much equity do you have in your house? And they'll look at me and maybe either give a kind of guesstimate, or maybe the cow to new gate, like they don't know. And I say, here's the answer: 0.
Right.
You have $0 in equity in your house until we have a buyer.
Right.
And the buyer performs.
Right.
So it's not enough just for them to say, yeah, we'll give you $500,000 for your house. They all actually have to perform on that contract. And when the loan funds, which that's your job, right? And the checks are cashed, now the money becomes real.
Right.
So for the prospective seller out there, before we kind of get into the more specifics on the down payment assistance programs, if you're a seller and you're thinking, I don't want to give somebody $8,000, $10,000, remember, you're leveraging the equity in your house to do that, which is not a real number until we actually have a closing. So you would rather sell your house for a net of $490,000 than not sell your house for $500,000.
Right.
I know you got chills right now because that's profound, isn't it?
Yeah. I look at it, from a negotiation standpoint. If you can negotiate at 500,000 and go to 510 and finance $10,000 in costs, then why not? Why not do that? Especially if you don't have that cash, or you have the cash, but again, it goes back to the premise of, what do I have in my pocket when I move into that home? Because if you get a home warranty, you probably solve a lot of the first year problems. In fact, there's data that's out from the state of California, and we'll talk about Cal HFA. But 85% of first payment defaults, or defaults in general, in the first 12 months of a loan come from something that's in the home, like an AC unit goes out, refrigerator goes bad, stove goes bad. These small, they seem minor, although AC unit's not minor, but these small expenses impact a borrower's ability to make that payment. And what are they going to do if they need a stove, they need AC, they need a refrigerator? They're going to spend money on those things first before they pay their mortgage payment. So in my mental space, I'm always cognizant of that number, that idea is like, what can we do to keep money in their pocket, so that in case they do have these issues, that they don't have to worry about it. They have cash on hand. And a home warranty thankfully solves a lot of those problems, especially those initial problems. That's why the state of California requires it. When you use down payment assistance, they're required to do the home warranty. But I think that
I did not know that, Greg.
Yeah, it's required. So and they need the full one. The
state doesn't necessitate who buys it.
No. It could be anybody.
The buyer could, in today's, it's just using round figures for, you said the full one. What I always ask for is the Old Republic Platinum Protection, and it's about $650 or $700.
Right. Yeah, and you can go crazy and get one for the roof. It's like $1,200, and you can go absolutely bonkers with it, which I don't necessarily always recommend. But if you want a peace of mind, it definitely helps. And having a home warranty is important. So, real quickly, let's segue into the down payment assistance. So, there's multitude of down payment assistance programs on the market today. You've got a whole ton of them. For the most part, the predominant ones that I think are the best when it comes to interest rates and terms is going to be the state of California, the Cal HFA program, California Housing Finance Agency. They've got great programs for FHA, VA, USDA, and conventional. Essentially, what they'll do on those programs, or that program, is called the My Home. And what they'll do is they'll give the borrower, or they'll lend the borrower, I should say, the down payment, or in the case of USDA and VA, they'll give them money for their closing cost up to 3%. For FHA, they'll do 3.5%. What you do with that is it's a silent second. The borrower pays. It's simple interest that stacks on annually. So for every $10,000, it's $100 annually. So it's a 1% simple interest. So super inexpensive. If it was amortized like a normal loan for every $10,000, that's about $1,500 annually that gets stacked onto that money as you go along. So in 5 years, 10 years from now, you paying a big, if it was amortized, it's a big chunk that you're paying back. In the case of state of California, they do simple interest. So it's very inexpensive over time. Over 30 years, it's only $3,000. So it's not a bad deal if you really think about how to finance this down payment or the closing costs in the case of FHA and VA.
I didn't know that they offered that kind of assistance with a VA loan.
Oh yeah, absolutely.
I did not know that. I don't recall ever having done a CalHFA deal with VA.
Most of the time they don't. Most of the time people don't guide them that direction, because VA is a no down payment loan anyway. So okay, we don't need down payment assistance. But if you get into a case where you need closing cost assistance, where you need something and the seller's not willing to pay for it, well, they'll give you 3%, and that covers your closing cost.
Well, and here's another way to think of it, Craig. So let's use the VA as a hypothetical. Okay, down payment, it's zero down. For anybody that is not familiar with a VA loan, it's zero down. One of the best deals going, but you're still going to have about 3% for closing costs. And you said that the state will lend up to how much?
3%. Mm-hmm.
Oh, 3% for VA. Okay, so let's say it's a $500,000 house. You're looking at $15,000 that they're willing to lend you as a silent second, which means we're not making a monthly payment on it. It just stays there until you pay off, until you sell the house or you pay off the loan. Then you would have to, right?
If you refinance it, right?
Or if you refi, okay. Which a lot of people did.
Oh, absolutely.
Yeah. Okay. But here's the way to think of it. You talked about putting money in your pocket. As part of our process and going through the purchase agreement, there is baked into the contract this contingency period. And one of the contingencies is an inspection.
Right.
So I bought a second home here a couple of years ago, and my eyes were kind of opened a little more now that I'm in that position of buying the house, right? As opposed to representing somebody who's buying the house. I got an inspection done on the house, of course, and I got a report, and there was a list of things that the inspector said needed maintenance or repair or whatever. And I'm the one buying the house. I'm the one responsible for those repairs. This is so important for the buyer to understand, okay? Because they'll ask, well, do they have to pay for it? No, they don't have to pay for anything, including repairs that are required by the lender. The seller doesn't have to pay for it. You could pay for it if that's what it came down to. Okay, so these are all the repairs that I'm responsible for. And for me, it's my house. So I wanted the whole list done. I sent the punch list to my handyman contractor. I said, I want everything on this list fixed. Now I'm going to come to the seller to request if they would be willing to help me fix all these items. And in this particular case, we had negotiated a little bit of a lower price. So the seller said, no, we are not willing to help you fix all these items. Well, guess what, Craig? If I'm getting 15 grand from the state and I can hold that back as cash in my pocket instead of deploying it into escrow to buy the house, now I feel more comfortable in being responsible for those repairs than I did before. And maybe it's not a deal breaker now.
Right.
I mean, that becomes a huge thing in keeping the deal together and keeping money in the buyer's pocket.
Right. Yeah, that's strategic. You have to have an open mind to creating strategies for your assets. If you don't have the funds, available for the repairs, and the seller's not unwilling to do that, what are you going to do? How can you strategically get money? And the down payment assistance program allows that.
Wow.
So it works. It works. It can work out even midstream. The state of California streamlined their process, so you don't have to worry about taking longer times for them to approve the loan. It's all digital. Typically right now it's about 24 hours, and it's only because of the program that was out in April. Now let's talk about that real quickly, because I think this is going to be a game changer if you can get the money. So in April of this year, the state of California released a program called the Dream for All. And the Dream for All program they had $300 million allocated for this program. And the program what it did is allowed the consumer to borrow 20% of the sales price on an interest-free loan, interest-free, silent second, no payments, and use those funds for the down payment. And then from there, once you sell or refinance it, the seller or you have to pay back the 20%, and then you're going to give them 20% of the net equity of the home after you pay off real estate agents and sell, all the different fees that are involved with selling a home. So it was a very ambitious program. And it's been around, it's been in different various forms in counties and cities throughout California for many, many years. Apple Valley had the same exact program back 2012, 13, somewhere around there. They had a very similar program on an equity, they call it an equity share program. And at the time, or the state of California did it, it was aggressive as all get out. And it went bananas. I mean, $300 million went away in 9 days. And it was very aggressive.
Back up, say that again. How much was allocated?
$300 million.
And how long did it take to exhaust those funds?
9 days.
Oh my God.
9 days. And it was
That's incredible.
Yeah, it was an incredible 15 days. The data that we have for me, because I'm a preferred lender for CalHFA and been a preferred lender for many years, and I pre-qualified and TBD approved, meaning they went through underwriting the whole 9 yards in a 15-day period. It was 65 people. If I could share my calendar, I'd have to share you that time frame was insane. It was 10 people a day. It was an insane amount of time. What it drove home was the idea that people are willing to buy a home if they can save money on the monthly payment and come in with a large down payment. Because in certain areas, like Riverside County, San Diego County, Orange County, 20% makes a massive difference in that monthly payment. Massive difference. Yeah. And so it was the program, even though it lasted 9 days, we were able to close. I think at loanDepot as a company, we closed about 100 of them. My branch, we only did like 5, so we didn't really get that many, but we had a bunch that were approved and ready to go that just the money went away in 9 days. So the people couldn't even get in escrow that fast. But so they're bringing the program back out. We don't know when. It hasn't been announced as of yet what date they're going to bring it back. They've got $200 million this time around. But we believe that this is going to be an ongoing program. If the state can continue to allocate money towards it, I mean, come on, $300 million in 9 days, they could probably put $2 billion to that money and it'll be gone in 6 months. And because it's just a very powerful program. So the program's getting re-released. We don't know what the rules are going to be. The credit report or the credit scores last time was 680. So you needed to be at a 680. You had to have a DU approval, which is very difficult to get even at 680. So the recommended FICO scores are about 700, 7+ if you can get it. We don't know what they're going to do about the assets. It is going to be, it's Fannie Mae only, it's conventional only, Fannie Mae. So it's very limited. The pool of people that are going to be able to get this money this next time around is going to, I don't know if they're going to open it up, make it FHA. I don't have a clue. But last time it was very small and it went away in 9 days. So if they open it up, I don't think they're going to open it up, to be honest with you. I think they're going to shrink it a little bit more because they only have 200 million. But it's a powerful, powerful program.
So you said the state's going to lend you the 20%. So let's use the $500,000 figure.
Okay.
And so we're going to do 20%, $100,000. They're going to lend you, and it's a silent second with no interest.
That's right.
So this means that the buyer, instead of using an FHA loan, which would be 96.5% of the purchase price, they're now only financing 80% of the purchase price, which is a huge difference maker vis-a-vis their monthly payment.
Huge.
I mean, you said it would be somewhere in the neighborhood of $800 to $1,000 a month difference.
All day long. Right. Yeah, absolutely.
And they're not having to pay on the $100,000.
Right.
Until they sell the house.
Right.
So if 5 years down the road, if we have a modest 3 to 5% appreciation annually over that span, and 5 years later they elect to sell the house for whatever reason, move up, move down, transition, move out of state, buy a bigger house, whatever their motivation is, and they've gained an appreciation of 5%. Which would be what?
25,000.
$25,000.
Mm-hmm.
So they're going to sell the house, or not 5% annually.
So 25%.
25%.
Right.
Yeah. So we're looking at 125.
Right.
Somewhere in there. So they've got $125,000 that they gained in equity, and they go to sell the house. Inevitably, selling the house is going to cost them about 7% or so. So they net out of the sale of the house $100,000. They're going to pay, you said the net equity, they're paying back to the state that 20% of that amount, $100,000.
Oh, 100, right. So 20 grand.
So they give the state $20,000 out of the equity they appreciated in that time frame, but they saved over that time frame. You said it was about $1,000 a month.
$1,000, yeah. 500. I could
be 12,000
a year.
I mean, I'm no mathematician. That's $12,000
times
a year.
That's a lot. Yeah.
And over 5 years, that's $60,000 you saved.
Right.
Now, again, I'm not a math genius, but if you tell me, look, Brian, I'm going to give you $60,000, and all you got to do is give me back 20. Where do I sign up?
Right. It's a $40 net gain. Yeah. Yeah, it's a very powerful program. I'm very hopeful that they allocate a lot of money towards it. I think it's in California, especially, it's the difference maker in many places that are extremely affordable, especially Riverside County, San Diego County, or LA County, even up here in the high desert.
Yeah,
it's there's at a certain point we're maxed out affordability wise. Only a certain segment of people can borrow, and buy a home nowadays. So how can we max out affordability and keep money in people's pocket? Lots of good things about the program. Here's another real cool thing about it too. Instead of doing 20% down, you could do 17% down and take 3% for your closing costs. So you can mix and match the down payment, closing costs, the whole 9 yards.
So they don't necessitate an 80% loan to value.
No, it could be 10%. You can do 10% and take 10. Well, you couldn't really do it necessarily that way, but 15% down and 5% towards your closing costs, and buy the rate down or something of that nature.
Wow.
And the real nice nice catch of the program too is the common thought is that we're going to the people are going to be able to refinance in the next 5 to 7 years, right? That's what the common thought is at this point, the common prediction, I should think. So the state of California will allow you to refinance one time and not, as long as you're just lowering the interest rate. If you're doing a rate term refinance, they'll allow you to do it one time, rate term refinance, and then you get the one time get out of jail free without having to pay them back. So the subordinate the second on that refinance, which is powerful.
That is
because
powerful.
maybe you don't want to move, you don't want to pull the cash out, but man, rates are at 4%. I want to take advantage of that, so they're going to give you that option, which I think is very powerful.
Wow. What's the name of the program again?
The Dream for All program.
Dream for All. That one, runs out of money fast because of how powerful it is. But the Cal HAFA has been around for a long time.
Oh yeah, that's and that's when you really look at if you're serious about home ownership and you want to keep money in your pocket, any sort of down payment assistance program is going to be relevant to your situation. It doesn't matter if you have the money in your account that you want to use for the down payment. Imagine being able to take say $30,000 for the down payment, and you keep your 30 in your account for different reasons, right?
Sure.
AC unit replacement, carpet, renovations, things
right.
of that nature become available to you if you use a down payment assistance. The other program that I think in the high desert is super strong is the USDA.
Yeah.
USDA in the outlying areas of Phelan, Adelanto, Lucerne Valley, parts of Barstow, Apple Valley. I think it's a very strong program. It's very limited on its scope, meaning it's very strict. The debt to income ratios are very, very strict with that particular program, and it kind of limits people. But it's no down payment. You've got the cheapest mortgage insurance available. No additional cost to borrow any additional money, anything like that. It's a very powerful program, but it's very limited in its scope because of the debt to income ratio requirements. And there is a smaller income limits for USDA. Just real quickly before I go before we move on, is the CalHFA income limits for San Bernardino County are 183,000 a year. So if you make less than that, you're going to qualify for down payment assistance for the state of California. FICO scores they start at 640 with FHA. Conventional is 680 typically is what you need to be at, 680 at this point. Debt to income ratio is 45. Unless you're above 700 FICO, then it becomes 50.
45 on the front end?
On both sides, yeah. Both sides. 45 and 45 on FHA, or anything below 700 is 45 cap. If it's above 700, back end as well, yeah.
Really? Wow. Yeah. So it's more restrictive then.
Very restrictive. Yeah. Well, ultimately, you're getting the state wants the consumer to have an opportunity to not be stressed.
Sure.
So at 45, it's unless they've got no debt, 45 is very stressful on a mortgage payment. But
sure.
If you've got combined debt to income ratio at 45 is not bad. At 50, it's a little bit more stressful, but it's not bad either. At 50, you can manage it, so to speak. USDA is 28 over 41.
Really?
So 28 payment ratio, 41 overall debt to income ratio. So you can see it's kind of restrictive. Yeah. There are a little bit of, you can move up to 33 and 43 if the borrower's got great FICO like 680 and above, but at that point it's still kind of stretching things out, and USDA is not a big fan of stretching. They're just but it's a very good program. The only drawback to USDA is no manufactured housing.
Limit on even if it's housing. On a permanent foundation.
Mm-hmm.
Yeah.
Mm-hmm. Yeah. It's got to be brand new essentially for USDA to do it. Yeah.
Well, Craig, you've been most helpful today, and again, just a wealth of knowledge as it pertains to these things. And if people want to get a hold of you, I'd like to hold you over, and we can go through the market update together, and you can offer any insight you want on that.
Yeah, go for it.
Okay. Yeah. Before we do that, we ask everybody to please like, share, and subscribe to the channel, to the podcast. It helps us to help more people serving their dreams, helping them, in the dream of home ownership and to win in life as well. All right, let's look at this week's market update. So and if you've never seen what I do here on a weekly basis, Craig, this is the 6 municipalities that provide most of our data. So I don't include in this analysis Barstow and Lucerne, as they're more outliers in the market, and the absorption rate for those areas is quite different, and can skew the numbers just a little bit. So this is Victorville, Apple Valley, Hesperia, Adelanto, Phelan, Oak Hills, and Hellendale. 7 municipalities. Last 30 days sold 409 homes. Our market, Craig, we usually move somewhere between 5,000 and 6,000 homes annually. So this absorption rate, particularly for this time of year, is low. I think what's contributing to this is this is an inventory problem. So it's hard to sell a lot of product if you don't have a lot of product to sell, if that makes sense. Median sale price, $415,000. Who's buying these $415,000 homes? Probably first time or first time in a long time FHA buyers that are looking for some kind of help. Just off the top of your head, what does a mortgage look like on this number? About $3,000?
About $3,200, something like that.
Yeah. This is the biggest difference between now and a year and a half ago. Is the mortgage on this is probably more like 22 or 2,300. Yeah, maybe 25. So you're looking at $500 or $600 a month difference.
Right.
Year over year, 1 year ago, we sold 464 homes in the same period, and it was about 1 year ago that the rate started to jump, right?
Right.
And the median sale price 1 year ago was $425,000. So we're down 11, almost 12% in the number of homes sold, but only down 2.3% in the pricing of those homes. Interesting, right? What is this? What does those numbers tell you?
Just we need inventory.
We need inventory, and the market's not going anywhere. So for that, because the pricing's been quite stubborn.
Well, it's limiting
the higher interest rate.
It limits who can sell houses. Because why would you want to sell a house when your rate's 2.5? Why would you want to buy something at 6.5? You know, it limit the mental capacity behind it all, or the mental stopping block, in my opinion, is the rate especially when you have a low interest rate on your first. Where ultimately I don't think a lot of people don't realize that a high interest rate is really not a bad deal. If you make a good money, if you make 6 figures plus, then having a high interest rate is a smart idea, because you have a much bigger Schedule A write-off that you can use on your tax returns. Sure. So that tax advantage is generally smart, but mentally most people are like, man, 2.5. Why would I want to go to 6.5? I got a 2.5 right now, and so
what it results in is the only people selling are the people that have to sell.
Right.
You know, like one of the clients I'm working with, they're moving to Dallas, so they had to sell their house.
Right.
You know, anybody that's it's an elective situation where, you know, maybe we want to buy something nicer and newer in a better area, they're kind of hanging tight right now.
Right. Which if you really think about it, if they, you know, I mean, looks like the median price has gone down a little bit, but that takes into consideration properties that are in low to moderate income areas or manufactured homes. But areas where if you're moving up, the prices continue to go up, and they'll be even higher next year. Very likely higher even further on down the line. You know, so what's that old rule or that old saying? The best time to buy real estate was 5 years ago. Right now is your 5 year. It really is. I mean,
so true. You know, the crystal ball, and you've been around, you've seen the good, the bad, the ugly. I mean, you've seen it all. The crystal ball, at least from my vantage point, I'm watching these numbers every single week, is that this number, the 415, you know, is not likely to come down, at least not significantly. And anybody that's waiting around hoping that this is your peer Pride Stromset over at Vintage Lending, the numbers from her today, 6.125% to 6.375% for a standard garden variety FHA loan at a 660 mid FICO score. And people are waiting and say, well, I'd like to see this come down to 5.1%. The challenge in doing that is twofold as I see it. Number one, this number 415 is not going to be the same at 5.1% as it is at 6.1%. It's going to be a lot more expensive. You're going to see this number jump up to 450, 460 pretty quickly. But I think the challenge, even more so than that, is if we see the rate soften at all, and I think I mentioned last week's show, everybody's kind of predicting a third quarter or fourth quarter recession. And that would be good news, ironically, for the housing market because the interest rates would soften a little bit. But you create more demand for homes. So for these 616 homes that are in escrow or active listings, 708 active listings, you create more competition for those 708 homes. It makes it harder for that buyer that's relying on seller concessions, down payment assistance.
Right.
They're more sensitive because of the ratios to the appraisal contingency. Whereas if you have a borrower that's, rich in assets, has plenty of liquidity to deploy into the house, they can overbid on the house. And that's what causes the prices to jump up and you're aced out of the market.
And that creates a comparable.
Pardon?
That creates a comparable too, when they bid over the price and they get it, and it creates a new comparable. So now your market is artificially inflated. Well, I think the last time we looked at some data was last year. When interest rates were really low, the median sales price jumped like 50%. It went from it was a 50% net gain in equity over like a 3.5-4 year period.
Yeah, for sure.
So if the rates were to go down, you would see the same thing. I don't think people really realize the relevance to low interest rates versus the price. If the rates drop tomorrow to 2.5%, the median sales price would go to 600 like in 90 days.
Yeah.
It would just jump up and go crazy.
Well, and here's another factor, Craig, that we haven't talked about. There's two big projects coming in the next 5 years. The high-speed rail, which is coming. Okay, there's land acquisitions already happened and money moving. And the other is BNSF moving to Barstow. You're talking about huge numbers when it comes to jobs and like you said, the 6-figure incomes. You start adding all that together, it's right. It makes my stomach turn a little bit because what we need is more homes.
Right.
And I don't know where those more homes are going to come from.
I agree 100%. We don't need lower interest rates. We need more homes.
I mean, it'd be nice if the rates came down to about that 5.5.
5.5, 4.5 in that range would be fantastic. Yeah. But even then, it would still the demand would still be pretty crazy, and there's just not enough housing at this point to.
Well, again, that's the 708 homes right here.
Yeah.
This is everything from, like you said, the lower to moderate income areas all the way up to the high income stuff. The more preferred areas, everything from, a $300,000 kind of starter fixer all the way up to the $1 million. It's and everything in between. And the normal number, a normal supply, you'd like to see about 1,500 to 2,000 here. So we're down like 2/3.
Yeah, and where are you going to get that from? I mean, there's just no way to generate that many houses. No, you would need a housing tracts that can knock out homes in 30 days.
Right.
Lots of them to keep up with the demand.
I sure would like if the state were going to do something, I'd like to see them address the supply side and not just the demand side.
Yeah, it would be smart.
Last question before we get you out of here. Do we hope at a 5.1 or 2 interest rate sometime in the next quarter or two?
Well, I don't have that crystal ball, but what I think is relevant to the situation or relevant to the question is if you look at where interest rates were from about 2008 after the crash, 2008 to about 2019 or so, 2018, they ranged between 4.5 to like 6%. They were kind of in that range.
Yep.
And then after COVID hit, now we've been in that 5.5 to 7.5 range. So from 2008 to 2009, that's 11 years where the range was pretty stable. I think we're in the new range, which is going to be between 5.5 and 7.5 for the next 10 years or so. I think that's my crystal ball at this point. I don't see there would have to be an economic collapse of the
Yeah.
United States in order for us to see rates back in the fours and in the threes and into those things. And I don't see the economic collapse happening at this point. I mean, if you want a job, you can go get a job. The jobs are plentiful at this point. One thing that people don't ever talk about is the demographics of the United States as far as age category. So you've got the millennials, you got the Gen Zs, and you got I think the Gen Ys. I think that even the young, those are massive, massive groups of people that are prone to over consuming. So when you have a consumption-based economy like the United States does, people are consuming tons and tons and tons, and that drives the employment. And when you have full employment like we do right now, you have a demand for housing, and then when you have a demand for housing, you obviously can see what's happening. And I think the inflation is part of that. It has a lot to do with COVID and supply chain and all that other stuff. But now that we've got out of that, the consumption is still heavily driven by the massive amount of people who have disposable income. And, I think that drives the economy. And I don't see people stopping buying the junk in the Starbucks and all the different things that they consume at this point. I don't see that happening anytime soon. So I think the economy is just too strong. Just no matter what. I mean, if the government may mess up or put us into a war of some sort, or something may happen at any point. But at the end of the day, the basic need for consumption is there, and then it's being fulfilled by, if you're 40 and below, man, you're a consumer.
Yeah.
And you consume lots. Lots.
Yeah.
And I think that's driving the economy. And without some sort of collapse, I don't think interest rates are going to go down anytime soon.
Wow.
I just don't. That's just my 2 cents. But I'm pessimistic when it comes to interest rates. But a lot of people are optimistic. But
well, it's good. People. I think people are better equipped to make their highest and best decision for their family if they're informed.
That's right.
And so it's good information. And we appreciate you coming on the show today. Thank you for the incredible amount of knowledge, and hope that this will help people. And man, I hope that you're able to, get 10 deals in escrow this week, my friend.
Hey, let's make it happen. Thanks for the opportunity.
Thanks again, Craig. Talk to you soon.
Yeah, buddy. All right.
All right, there he is, Craig Lawrence from the Loan Depot. Wow, very informative. Hope that you learned something today. Let's get to this week's edition of Check This Out. Film came out on July the 4th, starring Jim Caviezel, called The Sound of Freedom, based on a true story. And my wife and I are going to go see this film. It's released by an independent outfit, Angel Studios. And the film was actually made 5 years ago and stalled because I think it was Fox that was bankrolling the production, and they ran out of money and pulled the funding, and it took them 5 years through, I think, maybe even some private funding, audience donations, these kinds of things, to get the film produced and released. And it's about this gentleman named Tim something or other. I don't have his name offhand. I think Ballard maybe is his last name, who was an agent working for the government law enforcement to rescue kids from the human trafficking industry. My wife and I haven't seen it. I'm going to give you my review on it. We're going to go see it today, 4:00. And what's even more amazing is I think you can go on the Angel Studios website, and there are people who have paid it forward. If you can't afford to go to the movies, they've paid for your ticket already. So you can go on there and they'll gift you a ticket to go see the film. And it is outpacing Transformers and Indiana Jones and, the big summer blockbuster films. It's already done in the last, what is today, the 17th? So 2 weeks, essentially. It'll be 2 weeks tomorrow, $85 million. And it's being released into more and more theaters nationwide. So I'll give you my take on it maybe next week and let you know what I think. But in the meantime, it might be good to go support a film like this that is bringing awareness to a serious issue in our society and in our culture. Well, that's all we have for today, friends. We're just delighted that you came. Again, a special thanks to Craig Lawrence at the Home Depot, and hope you learned some things about down payment assistance. Until next week, we are serving your dreams and helping you win in real estate and in life. We'll see you next week on The Brian Hirsch Show.